All right, guys, I suggest to start. Welcome everyone to the 8th community call dedicated to liquidation markets. And we are so excited about our recent release on mainnet. And it's currently in early beta mode, which means that you already can try the product. And for doing this, you simply have to request the access at the website, and you can find the website link in the Telegram group in a pinned message, or just we can drop the website here in chat. Yeah. And as our main task right now, we are moving to the mainnet release, which we expect to have in like 2-3 weeks. And as for the agenda for today's call, our team will make a quick overview of our progress since the last call and discuss the our open questions we have, and we can answer to have Q&A session to answer the questions community has. So yeah, we can moving forward. So basically, during this week, our main focus was the integration with 1inch, so we can sell the collateral efficiently. Right now, it's work in progress. Also, we were working on an asset manager, which allows the pool to allocate assets in periods of low volatility. And as I mentioned at the previous call, we are considering the idle option. Also, we are making fixing of like current bugs, and more details about contract parts can provide our engineer Kostya. Would you like to make an update about contracts part?
Yes, sure. Hello, everybody. So I'll share my screen. So we have implemented some new features, and the problem was when we participate in auctions, so we log DAI in maker contracts, so we are not able to withdraw it at any time. So this is the problem, because when a new user wants to join the pool or withdraw his tokens, this makes problem to calculate token rate, to calculate what exact amount of DAI we need to withdraw, and what amount of pool token we want to mint when we add liquidity to the pool. So in previous version, we use log functionality for this. So how it works? When we participate in the auctions, we log the pool, so nobody is able to exit and nobody is able to join during participation in the auctions. And we changed this. So how it works now? I want to show. So first of all, we track all allocations of keeper adapter. So we can have multiple keepers. So we track individual allocations, and so at any time we know what exact amount is allocated for keepers. And So we use this to calculate token rate, and when yeah, here it is. So this allows us to join the pool during active auctions. So we calculate token rate based on available DAI balance and allocated amount in for keeper in auctions. And what about exit? When user wants to withdraw his pool tokens, we implemented withdraw queue. So what's withdraw queue? If user wants to withdraw some amount of his tokens during active auction phase, but we don't have this amount in pool, we create withdraw request. And once this money will be paid back by keeper, keeper bot will call withdraw queue execution, and this money will be sent to the user. So now we have functions to create withdraw request. Also, withdraw request could be removed. And this function, process withdraw queue, is used by bot to process withdraw request one by one. So this is how current implementation works with active auctions. Yeah. So if you have questions, I can answer them.
Okay.
So these are the major changes that we made during this week. So
thank you, Kostya. Thank you. Okay. Also, as a progress we did this week, we were working on our bidding formula, and right now it's finalized to go to mainnet, and also we did some simulation and calculations to understand to finalize few our parameters, and we did this like this week. So yeah, it's also the part of the current progress. Yep, and that's pretty it. If you have any questions, you do not hesitate to ask them, and then we can go to the discussions. Okay, if there are no any questions about the progress, we can move forward to the agenda. As the first question I have from my side, we started discussing internally what kind of the next protocols could be integrated to perform liquidations. So basically, among the options there are dYdX, Compound, Futureswap, Opyn, and also we can consider even centralized exchanges as an option if there will be the demand. So there are Deribit, BitMEX, Binance, and the volumes there are pretty high. So why not, if there will be a demand for these pools as well. So I have a questions to the community. What do you consider should be the next priority to add pools for liquidations?
I think dYdX, because or any other markets where liquidations could be performed in the up market, while the maker is only the down market.
Yeah, we briefly discussed this the previous calls. We had dYdX and other exchanges with this logic really have the advantage, because it's possible to perform liquidations even if there are no volatility, but the market is growing. There still will be liquidations because of short positions. Yeah, it's probably maybe a good option. Any other thoughts, suggestions, objections? Okay, we will continue investigating different opportunities, and if there are maybe further ideas, you can drop them in a chat directly.
Yeah, I would like to give a quick update on the hedging strategy, which Andrew McCuskey suggested during the last community call. I have reached out to Futureswap and gauged their opinion on whether this is feasible or not. Does it have legs? And what is the interest from their side to help actually define, build, explore, integrate, and so on. The good news is that the founding team looked at it as a very interesting, attractive use cases. They basically, I quote, "That's exactly the type of apps we want to be built that would use Futureswap." And the next step suggested was to have a conversation with 2 of the 3 co-founders, and that's the options they gave us. The challenges that I found identified is apparently the problem that I expressed that might be a blocker for the feasibility is that the fee, at least in the alpha, when Futureswap was running their alpha, the fee was one-time upfront charged when you open the position. That means that basically this particular fee structure is not, it could basically make the hedging strategy obsolete, because it basically maximizes the amount of traders who use basically very long average position duration, right? And all the strategies that are hours or minutes, right? It's kind of discouraged for at least this makes it uneconomical. Because if you need to pay 0.5% just to open the trade, right? And if you are doing it to cover the risk for short periods of time, right? It basically makes it uncompetitive. This is the single most important problem I have found. But otherwise, this it seems like it has legs, and we should certainly put it in the roadmap to design, validate this strategy, because at least I have not received what I wanted to get is like, oh no, it's not going to work. And we didn't get that. We got the opposite. Yeah, makes sense. Interesting. Let's explore how to do it. So that's the update from my side.
That's interesting. Maybe Andrew, can you provide maybe some some insights. Maybe you are working on anything this week.
Hi guys. Yeah, 0.5%. It's like a small fortune. I would say it's too much. Why not use centralized?
Yeah, go ahead.
Today I heard Vadim talking about centralized exchanges as an option. Is that right, Vadim?
It's not that we have this on our roadmap. It's just a thought. Maybe there may be some demand for a separate pool with centralized liquidations, and if they don't matter for such risks that may be involved, why not? But we don't have like these plans on the roadmap right now.
Yeah, before we go into the centralized solution, right, which is attractive, might be there might be ways to do it, right? Technically, the building blocks. I have at least some specific mechanisms how to do it, and it's now possible. It was like 3 years ago it wasn't possible, or even a year and a half ago. But this is much greater in scope with like. At least we should go. It seems to me, before we go that route, right? We need to understand the use case and the exact parameters and limitations, right? What to basically do a feasibility study. The question to you, Andrew, what do you think about the scenarios where it does not make sense, or what do you think is the price? Let's say we go and have this meeting with Futureswap, and they ask, okay, what if we could change the pricing or make different pricing tiers, right? Because the short-term hedging might be a use case that not only you but a lot of other people may use Futureswap for, right? How much are you willing to pay?
Like the basic fee?
Yeah, like what kind of pricing would you like to see on whatever Futureswap, FTX? It's not only about them, right? It's there will be ways to hedge positions, right? We can use options too, right? It's not just I think, if I understand correctly, futures is just one product that can enable doing it, right? Buying and selling options is another one. Is it correct?
Okay, my answer is we can pay as much as it's economically feasible. So if our margin is 1.5%, and you pay 0.5%, you have 1% of extra income. I would be in this deal.
Okay, understood. So basically, the economic feasibility is kind of this ratio. If we're beating with, let's say, minimum discount, right? Let's say if the bid that will go in will be for a discount of 3%, right? And that's
so our margin would be 2.5, right?
Yeah, so we basically, as long as we have some spread, right? If it costs 0.5 to open and close, right? Then we just need to decide how big of what is the maximum percentage of our spread, right? Of the discount that we're willing to use. And if this hedging option is available at this cost, right? Let's say we're willing to pay up to 50% of our expected profit, right, in hedging, because it reduces 80% of risk, right? Defining these parameters is the way to go, right?
I want to clear out the following point. Who this fee goes to? To the Futureswap team or somebody else?
No, it doesn't go to the team. It goes to the market makers, liquidity providers. It's basically the protocol charge, right? Just like Uniswap fee goes to liquidity providers.
I see no problem. I see no problem here of making a deal with these market makers. It depends. Of course, it depends on the volume. The greater the volume, the less could be the fee, and we can dictate our rules, don't we?
Okay. Yeah.
We can make a bargain here.
It's kind of yes and no. The yes, we can totally do the negotiation, right? But no, we don't negotiate with specific market makers. We need to convince the protocol.
Yes.
Right now, it's the founding team of Futureswap. Later on, it will be the holders of FST tokens, right, to implement a change, making the fee structure so that you basically pay for the amount of time that you're using as a trader, right? So if your trade is only 1 hour, right, then you don't pay 0.3%, similar as the guy whose position is, let's say, 6 months, right?
For a long term.
Exactly.
Okay. Just forgot what I wanted to ask you. I suppose this is on their roadmap. What I was trying to find out is to ask you is, do you have to pay for opening the position and for closing, or
I think it's only for in the alpha only for opening.
So our risk, the risk for Atomica team would be to suppose you sell the futures and you pay 0.5%, but you don't get the collateral from the auction.
Mm-hmm.
And in this case, you have a loss of 0.5%.
Mm-hmm.
You should weigh this scenario too.
Yes, correct, because there is like total of 4 scenarios, right? So this is one of them.
But it's an unusual situation where you have to pay, where the maker pays the fee. Usually it's the taker in DEXs. I don't know why maybe because they are the first in the market.
Yeah, and it's not like they're not the only one that will provide the venues, right? I mean the decentralized non-custodial version, which what we need, right, without venturing into centralized custodial solutions. And the pricing is not set in stone, right? The beauty of it is that if the use case is big enough and we're not the only ones that need that, they will change it, right?
You can count yourself as an institutional, and you are actually.
Well,
gets a better deal. Usually get a better deal.
Yeah, institutional contract.
Yeah.
that is irreplaceable, immutable, unkillable institution as a contract. Okay.
If you were doing HFT, high frequency trading, and paying 0.5, you'd be robbed.
That makes sense. It just we don't assume it is what the market rates will be 6 months or 12 months from now, right? There is nothing that prevents someone to launch the same thing with zero fee, right? It just I don't think we should be like trying to optimize for that. What I would like to ask the question is 2 questions. Number one, what about options as a better interface, assuming we're using an option that is priced with I don't know, automated market maker type of scenario where you can buy and sell into a pool where there is no need for counterparty, right? And you just buy and sell for in a short period of time, right?
Are you talking about options, like
Yes.
stock options? Oh, that's
Yeah,
out.
like American or European style options, like hedging, open.
You know, it's a
permutation.
it's a way too different game here, because you have too many variables, like volatility of the option, implied volatility, and this volatility, when you have a market falling, this volatility explodes like a balloon, and you can buy the option way too overpriced, and then when the market subsides, when the fear subsides and you sell it, you have no profit at all. Believe me, it's quite a different game here. Better use futures, better, way better.
Assume what I was describing is where the options are priced through the automated market maker mechanism, right? Where you have much more not control, but at least you know what to expect, right? So if the price is going down significantly, right? Here's how, basically by
Rinat, I think you're just wasting your time, because you know, I traded options in quite liquid markets, and there were quite wide spreads. The options usually have pretty wide spreads.
Much wider spread. Yeah, understood. Makes sense. Well,
you can have 5%. You can have 5% or even more. 5+% of a spread. It's much greater than 0.5.
Got it. Understood. All right. Well, it just it might be that we can use it, but it requires, like, for example, if we basically use it for hedging that involves much more longer time frames. Basically, in case we are in scenario 3 using futures, right? Like with options, we may end up with some collateral, but that is protected. But anyway, it's much more. It's not that important this time, because the second question I have is, what do you guys think about the right time to actually spend efforts on this hedging strategy at all? Like when? Is it now? Is it is it the problem we need to solve now? And if not, when do you think the problem will need to be solving, so that I know that when we I need to give some status update to Futureswap, right? Give them feedback and say when we coming back. And they're also not on mainnet again. So are we talking about June, August, like, or upon certain conditions to be met, when it actually will be making sense?
What exact problem are you talking about?
The problem and solution to this taking the risk in bidding strategy, which could be mitigated. We have a choice of if we enable this hedging strategy, right? We will avoid
like
the situation. Yes, we will avoid the situation for a price, right? That the performance of the keeper pool, right, of the liquidation market number 1, 3-6 months later, is very poor. If we want to avoid that, then we can deploy this hedging strategy, right?
You know, I was thinking about this strategy of selling futures. It depends on the moment you bid on the auction. If you, as soon as you bid on the auction, as far as I understand, you can't take out your bid. You can't get off with your bid. You can cancel it. So suppose you sell the futures. Let's say the Ether now is $200, and you sell the futures at 200, and you make a bid at 3% below the market. So basically, it doesn't depend whether the market falls or stays on the same level or goes up. You have a fixed possible income of 3%. The only case you can lose, I was thinking about extra income, but extra income, it's not possible here because you make two transactions at once, selling the futures and making a bid. If you sell the futures first and then bid later, basically you're trading, you're speculating. It's
Correct.
it's not arbitrage. It's just speculating. The price can go up, and you'll encounter all the problems usual traders have.
Okay, so are you saying that? So do we have to open the short position on the futures when we make a bid or when we win? And then
When you make a bid,
we will be trying going to liquidate. What if we buy when we only win?
When you make a bid only, it doesn't make sense in other situations. And I think you should consider this future strategy only in case you have problems with liquidating your collateral on the Uniswap and other exchanges.
Yeah.
And I think
Okay,
you'll have
so how about we first validate how big of a problem we may have liquidating?
Yes, and then you decide. Yes.
And then we decide if this problem exists, and if it is, if it's worth solving.
Yeah, and another solution could be, I was weighing the risks of, usually I add up all the risks into one heap, and then I weigh two possible options. For example, DeFi ecosphere is not so safe as they speak about it. Sometimes you have much more risk of hacking a smart contract than you have the risk associated with the centralized exchange, with the custodial exchange, and this risk can at times outweigh this custodial option. And if the smart contract is not audited, if it doesn't have a nice stuck for a word from white hackers, a good bounty for white hackers, I would consider this strategy a risky one. I would choose better BitMEX or Binance, but I wouldn't go with leg. I wouldn't go on the margin trading. Only the ratio could be only 1-to-1, no more, because you can get out. I have some acquaintance who's got their acquaintance who lost tens, no, maybe not tens, $100 million on the 12th of March when the BitMEX just switched them off trading and they couldn't liquidate their position. And the irony was that they had the risk management strategy, but they just couldn't reach for it.
Couldn't use it, yes. Okay, understand. All right, so I suggest that we revisit this topic when we get the results of the, well, we will have a couple of data points in the next weeks and months. The first one will be a test environment with 1 inch, where we will get some clues about what it actually could mean for liquidations of newly acquired collateral, right? Second input we will have is we will begin pushing the envelope on like minimizing the amount of time between the bid, right, and the end of the auction. Because if this amount of time is only like 3 blocks, right, then this hedging strategy may not be as important, assuming we don't have problems with liquidations, right? And third, once we get to operate it in real world environment, right, we will get both our own data and feedback from new users, members, existing liquidators on actually whether it makes sense, because I think that's where we should look for significantly, because the traditional the liquidators who operated in the maker ecosystem, right, they all custodial, right, and a lot of them, they basically already worked for a long period of time using centralized exchanges, using and they are quite sophisticated operators. It's reasonably to expect that they would use BitMEX to hedge it, right? So I think these are the guys that we should be asking for on when it makes sense, and just get their feedback on incorporating it and spending time or not on this area. But we need to be on mainnet to actually get a meaningful feedback from them, so that they're evaluating a product with the real money, and ideally some already integrated venues, 1inch and so on, before we get to make any decisions on spending resources on this. Does it make sense?
I just wonder how you're gonna make them tell you all about this. They are
Because
your direct competitors.
Some of them not. Some of them are interested in doing it in the pool, right? Because what are they losing, right? They're getting to use infrastructure that they don't have to pay for, and they get 100% of the profits, of course, pro rata share, right? And of course, they can run their proprietary strategy, right? And if it's their unfair competitive advantage, that's fine. But we have seen individuals that do not wish to run their own. They've done it, and it's just too much work for too little profit, right? So they basically say, okay, I'm willing to outsource it, like Sid.
Yeah, that makes sense.
And they got something to learn from us, because if they can run, for example, proprietary strategy, right? We have already discussed it for the roadmap, is that these individuals can run the strategy where no one can deploy money except them. And no one can see the code. But they're using the pool, where the pool and the on-chain bidding, right? But the liquidity providers are only themselves.
I just got an idea of widening your audience of your potential customers. If you're going to have such people who are going to use their proprietary strategies of selling the ETH, you can allocate ETH, not DAI, and sell back ETH to clients. And then they are going to sell or store, hold the ETH. It's up to them. It's like selling, wholesaling.
Yeah, I understand. Well, it's basically like what, if I understand correctly, please confirm. You're suggesting to have a pool or integrate with a protocol that allows effectively get commitments to sell ETH at a slight discount,
yes,
right? But have a much more direct connection with the sellers, right?
That's right.
Okay.
It would be much easier. No problems associated with selling collateral. All that stuff with futures, with Uniswap, liquidity issues, fees, etc. Quite reasonable. You can test the product market fit for that. Why not? And see the
but the sellers, we're interested in the buyers of it, not in the sellers. We're the seller, right?
So you
So
actually
in
collect Ether. You collect Ether from the clients. You convert it to DAI. You participate in the auctions, get back ETH, and the clients can withdraw ETH.
Oh, okay, got it. All right, cool. Yeah, we discussed this, and it's a bit challenging, but it's doable. We effectively, it's not only about ETH. There's probably a big percentage of well, probably a large, probably up single digit, like I don't know, 5 and 10% of a little bit like more sophisticated than average market participants who are not necessarily active traders. These are basically typical the typical customer of a social set on set protocol, right? The typical user of set. So this is the target market, and for them, I think it might be interesting to deploy ETH and as soon as there is a down market, right, the ETH converted to DAI is used in auctions, and then when the volatility subsides, they go back to ETH, they deposited ETH, and they got the ETH back, right? They never see DAI, but it's only converted for the periods of wartime, right?
Right. And
Okay.
I also strongly suggest that you log every stats in the system, everything, so that you can later analyze and find the loop, find the narrow bottlenecks and where the most of the demand is, and all that stuff.
Okay, got it. Thank you, Andrei, for great ideas, suggestions. Vadim, what's the next, or wrapping up?
We can potentially cover one more topic as for ground strategy. Today we have Elena. Maybe are there any interesting insights you would like to provide, or if there are any?
Yes, sure. I have update from my side. I'm currently working on 2 grants proposal. The first one is the maker grant proposal application, and the second one we consider for the grant application Agnosis safe apps. So now we are considering this option and thinking how to upgrade the current product and make it compatible with the Agnosis safe apps requirements. The work now is in progress, and the main constraint that we have here, the both applications need the audit, the technical audit of the smart contracts is done. So the plan is to prepare the application and prepare the code for the audit, and in parallel prepare the grant proposal application, and then go for the grant. That's all from my side.
Cool, thank you. Yeah, if maybe there are any questions from the community side. Sorry. Okay. If there are no any questions, we can wrap up. Yes, thank you for attending the call. Thank you for ideas and thoughts. I'd like to remind that we are in early beta mode on testnet, and it's possible to try out the product simply with our website and request the access, and our team will provide the access shortly. and it would be great to hear your feedback. We highly appreciate any feedback, critics. It definitely helps us to improve the product. So yeah, feel free to provide any comments you have. So thank you